Welcome to Crisis in Perception, where we examine the systems shaping our world, one book at a time.
Today we're diving into the American racial wealth gap, and our guide is Mehrsa Baradaran's incredible book, The Color of Money. Now, this isn't just about numbers on a page. This is about the financial fault line that runs deep underneath, well, pretty much everything. Housing, education, you name it. It's the system behind that old saying, when Wall Street catches a cold, Harlem gets pneumonia.
This quote from W.E.B. Du Bois it really hits you, right? He's not just talking about individual poverty. He's pointing to a huge systematic economic hardship that's lasted for generations. So the big question is, how has America tried to fix this?
Well, for more than 150 years, leaders have looked at this problem and pointed to one solution that, on the surface, seems to make a ton of sense.
The question has always been pretty straightforward. If a whole community is shut out of the main economy, how on earth does it build wealth for itself?
And for over a century, the answer that came back from all sides was, build your own economic engine. The idea was simple, really. Create black-owned banks to pool the community's capital, finance homes, and fund local businesses.
Now, this is where it gets really fascinating. Just look at the names on this list. I mean, think about it. Frederick Douglass and Richard Nixon, Malcolm X and Barack Obama, we're talking about everyone from the Black Panthers to Alan Greenspan. It's maybe the only idea about race and economics that just about everyone agreed on. It felt like the perfect solution.
But, and this is the book's central argument, this solution, with all its promise, was basically set up to fail from the very beginning. And not because it was a bad idea, but because of the system it was forced to operate in. You know, we hear a lot about the invisible hand of the free market, like the wealth gap just happened. This book argues, no, it wasn't an invisible hand at all. It was the very visible, coercive hand of the state. We're talking about deliberate policies that actually built two completely different American economies.
And this chart just lays it out so clearly. You've got these two tracks. On one side, the mainstream economy was supercharged by the government with supported credit and guaranteed loans, the kinds of things that help assets grow and build wealth. But on the other side, the segregated economy was completely cut off from that support, left with high-risk loans and property values that went nowhere. Just look at the bottom line here. One system was designed to create wealth, the other to contain it.
So what do you think happens when you take that engine of capitalism, a black-owned bank, and you drop it inside an economy designed for containment? Well, it turns out an engine is pretty useless if you don't give it any fuel.
You see, a healthy bank works its magic for something called the money multiplier effect. You put money in, the bank lends it out, that money gets spent and redeposited, and this cycle repeats. This process is how new capital is literally created, fueling growth in a community.
But for black banks, that engine was completely starved of fuel. It got stuck in a negative feedback loop. The deposits, to start, came from a low-wealth community. Then, that money was loaned out for homes in segregated areas that, because of that segregation, didn't increase in value. So the bank's money multiplier just fizzled out. It couldn't grow. And the result? Poverty was actually reinforced, not solved. The engine was just running on empty.
To really get our heads around this, the book gives us a really powerful metaphor that makes it all click.
Just imagine for a second that building wealth is like trying to climb a ladder. And of course, climbing takes effort, right? You've got to work hard, save money, make smart decisions. All of that is like pulling yourself up, rung by rung. But here's the key insight, the part that changes everything. All that effort, all that climbing, doesn't mean a thing if you don't have a solid floor to put your ladder on. And that floor? That's the state-backed credit system. It's the FHA loans, the FDIC insurance, all the government guarantees that absorb risk and make sure assets are stable. The mainstream economy got this solid, concrete floor to build on. But for the black community, that floor was deliberately pulled out from under them by policy. They were given a ladder and told to climb, but they were denied the very foundation that makes climbing possible.
So when you start to see the whole system like this, what does it change? How does it shift our perception of the problem itself?
Well, first, as the author says, it forces us to ditch the myth that separate can ever be equal. Asking a segregated community to fix its own poverty is like asking a boxer to win a championship fight with both hands tied behind their back. It's just not going to happen.
So the most crucial point is this. The racial wealth gap is not some kind of accident. It's not a market failure. It's the logical, completely predictable outcome of a two-track economic system created by policy. The system isn't broken. It's working exactly as it was built to.
And that leaves us with one final, really important question to chew on. What changes when we stop seeing the wealth gap as evidence of a community's failure and start seeing it as evidence of a system's success at doing exactly what it was designed to do? This project is free and publicly accessible. If you'd like to support the time, tools, and research behind Crisis in Perception, you can become a supporter on Patreon. For a longer, audio-based analysis of this topic, see the deep dive linked in the description. If you enjoy this kind of systems-level analysis, please like, subscribe, and comment with books or topics you'd like us to explore next.